Well, first, thank you everyone for zooming in tonight. This is an intro to venture funding. I am Forrest Richter. I'm the CEO and co-founder of Uncrowd.io. And this is really, it truly is an intro. This is welcome to step zero of venture funding. I want to give a quick background on myself because I think it sets the table. I went to school at the University of Minnesota, which notably is not an Ivy League school. I just have a bachelor's degree. I do not have an MBA or a JD, which is will be relevant in a second. I started my career very traditionally corporate, operations marketing. From there, I transitioned into some startups. I worked at Bright Sellers. I ran operations there, which was my intro to venture funding. Then I helped set up operations for another Milwaukee startup group, which is Moral Code and Milwaukee Boot Company. Those are both men's footwear brands. The reasons I want to share this is because I am very much a VC outsider. I do not follow the normal trend. I will say openly, I am fairly critical of venture capital as a system. I think there's a lot of things that could be done differently. So I want to set the table for that heading into this conversation. The way I got into venture capital was kind of by accident. I had to fundraise for the very first time in my life, and I didn't really know what that meant. And I didn't really know where to go or what to do about that. So I just started reading things. And I have felt like since I've gone through that process, there's always a sense of kind of the haves and the have-nots within venture capital, and not even literally the dollars, just the knowledge, the language that is spoken in the venture funding world. And it really is an intimidating space to get into when you don't have that knowledge. So it's really important to me to be able to bridge that and share that with as many people as possible and help create some comfort around venture funding so that founders are able to talk about it and talk to investors in a way that feels natural and comfortable. So first, how large is venture capital? In the United States, there was $130 billion worth of funding in 2019. Now, that is large. I also want to note, I have some definitions that I'll try to highlight throughout the presentation of things that are industry jargon. So the first one I'm going to highlight is the term dry powder. So dry powder is capital that a VC fund has raised but has not yet deployed. So understand that that $130 billion is deployed dollars in 2019. There is a lot more money that is sitting there that had not been deployed yet. So the actual dry powder number estimates are somewhere around 2x that number, twice that size. To give a high level on what is venture funding or equity-based funding, equity financing is the process of raising capital through the sale of shares. By selling shares, they sell ownership in their company in return for cash, like stock financing. That is an official definition. The right way to think about it is you are selling a portion of your company to somebody else, and you are selling that portion theoretically to do smart things with that money. So the person that's buying a portion of your company believes that them giving you those dollars is ultimately going to grow your company. And then for you, or for them, that will be a return on their dollars when your company gets bigger. There are kind of three areas that we will see for equity-based funding. The first is usually our first money in, which is friends and family around, and fools, which I'll talk about a little bit. Then we have angel investors, and then we have venture funds themselves. Friends and family, I don't think I need to go too deeply into what they are. It's the people you know, but also fools. These are the people that these are the people in your immediate network that you can convince to give you money. These are people that when you say, hey, I'm doing a business, I have an idea, they say, great, I'd love to support you. And they're willing to help you financially. Now, occasionally throughout this presentation, I will give nods to underrepresented founders because that happens to be the group that I care about and support. So women, Black, Indigenous people of color, LGBTQ plus founders who are grossly overlooked in venture funding. And this is one place where I'll make a nod here. So a note on first money in. The income difference in the United States for Black families versus white families is 54%. And that's just only telling a little bit part of the story. The net worth difference for Black families versus white families is 10x. So really what that means is if you are a Black founder, it is much less likely that you are coming from a place of discretionary income from your house and from your community. So this is a grossly overlooked portion. I actually think one of the most overlooked portions in venture capital for for potential founders. And it's a real opportunity. And so I just like to leave a note here that microfunding matters. I think a lot of VCs, especially larger VCs, really neglect how hard it is to even get to a place where a company makes sense for them if you don't have this discretionary income available. So what is angel investing? Angels are accredited investors using their personal wealth to purchase equity in a company. A couple definitions down below. First, an accredited investor is an official term. Again, all the focus tonight is on the United States, at least as far as the definitions go. I know that we have some people here internationally, and I'm sorry, I'm just not super informed about it, but it's very similar to the United States. I know that. But we have an official designation in the United States called accredited investor. And an accredited investor is someone whose income exceeds 200K or 300K combined if married, or a joint net worth of $1 million excluding their primary residence. Basically what this means is you are a rich person and you have discretionary income to risk on high risk investments like private equity or in angel investing. You also might hear the term HNWI. That's an acronym for a high net worth individual. Essentially means they are a proven accredited investor. Now, there is no official process for becoming an accredited investor. You don't have to go to the SEC and ask to go through a confirmation process. But if you are actually investing in a company and you're filing papers with the SEC and there are some questions about whether or not someone's accredited, it could cause problems in your fundraising. Now, getting back to angels, what do angels care about? Well, first and foremost, they care about value. Like anybody who's making any investment, they're looking for returns. So if you have a smart business that has a smart plan to scale and a smart plan to return money to them, you're going to have an easier time with any angel. But one of the things that's a little more unique with angels is occasionally you will find angels that care less, sometimes not at all, but sometimes less about value and a couple other things. So sometimes you will find an angel who just believes in you. They care about the founder or the founding team. They don't really understand the market. They don't really understand the opportunity. They don't really understand the product or care about it even, but they do care about the founder and they believe in the founder and they want to help the founder. Definitely something an angel might do. The other side is on the product side. And the product could be an angel just wants to be involved in the space. Sometimes it is more fun to sell a cool product. In the same way, it's fun for someone to be a partial owner in a cool product. I can tell you this as somebody that was involved in both a wine startup and a men's footwear startup, tend to attract a different type of, or at least people that think it's fun to be an investor in that space compared to something like that maybe we would all consider a little more boring. So venture funding. When we get to a little bit of a bigger level, venture funds are investment funds that manage the money of investors who seek private equity stakes in startup enterprises. These investments are generally high risk, high return opportunities. Again, very jargony language on the definition. So I'm going to walk you through at a high level a venture fund operates. I am taking some liberties here. I've seen some of the names on here, so I know there's some people that can and will call me out and say, hey, that's not exactly how that goes. I'm just going to ask that you're patient and understand that I'm just giving a high-level overview. So the first thing to understand is the person who is starting the fund is called the general partner, or GP. Sometimes there's an individual, sometimes they're a group of individuals, but they are called the GPs. And what they do is they go out and first solicit money from limited partners or LPs. Limited partners can be corporations, they can be groups of family offices, they can be individuals. But essentially in this example, the general partner went out and solicited from the limited partners, the LPs, $10. Now you can add probably as many zeros onto that $10 as you like, but for the sake of easy math, we're going to stick with $10. Now, the way that a venture fund makes their money is called the 2 and 20 model. I will come back to this later when we're doing some more math, but essentially the 2 and 20 model, it means that they get 2% of the fund in operating costs per year. So that's how they pay, that's how they take their money home, that's how they keep the lights on, that's how they do their due diligence, that's how they find their companies. And then the 20 piece comes at the end of the fund when the fund returns and how they get their share of the returns, which we will get into in a second. So in this model, this general partner raised $10 from these LPs. Oops. Now, this general partner then takes that $10 and distributes that $10 to a bunch of startups. In this example, $4 to startup 1, $2 to startup 2, and $4 to startup 3. These startups then become the general partner's portfolio. The portfolio of the venture fund are the startups they invest in. Now, as we follow this fund over time, and let's pretend that we're talking about a 10-year span, this startup 1 does something really good. They get acquired. That's one of the goals of being a startup, is to have an exit that's positive. You have it, and they got, in this example, they got acquired. Startup 2 got really, really big, and they had an IPO, an initial public offering, which means that now their stock is available for the general public to buy. You don't have to be an accredited investor anymore. Earlier this week or last week, we saw a really large IPO from Snowflake, which is a software company. And then startup 3 did what the vast, vast majority of startups do, which is fail. So what did those returns look like for this fund? Startup 1, after getting acquired, brought back $40 on the $4 investment. That's a 10x return. That's great. Startup 2 IPO, they were a huge, huge win. We put $2 in, we got $100 back for a 50x return. And startup 3, we put $4 in and we didn't get anything back because they failed. The first thing we need to do with this $140 is we need to repay what the LPs put in originally. We give them their $10 back. Now we have $130 to figure out what to do with. So this is where the 2 and 20 model comes in. So assuming that this was a 10-year fund and 2% of the $10 was going toward running the fund over those 10 years, well, that's $2. Then we have this 130 left over, which is 20% return on that. So they get the 20% of that leftover 130 after 20% of whatever's left over after paying the LPs back on their original money. So in this case, that's $26. So this fund made out with $28 after essentially, at least in this model, putting no money in. And again, let's add on somewhere between 6 to 9 zeros for fun. So then the rest of that money then goes back over to our LPs who put $10 in originally. Now they're walking away with an 11.2x return if you count the whole 112. If you don't, that's fine. You can say it's closer to a 10x return, and that's fine. But ultimately, this would be a model of a very successful venture fund. So then what happens is this GP then goes back out into the world, usually, and then resolicits maybe some of these same LPs or some new LPs and says, look at this work I just did. Look how much money I made all of these LPs. Now I'm going to do the same thing and make you that money. And then all of a sudden, the initial dollars coming in are not 10, they're 20, they're 30, they're 40, they're 50. And that is how we end up with some giant mega funds. So I know we have mostly founders here. So how do you attract venture investors? Well, there's a process: connecting, pitching, and then securing your funding. First thing to do is connect with investors. And I like to be clear to founders about this because I think a lot of founders put investors up on a pedestal. Sometimes investors act like they're on a pedestal too. But investors are normal people. And for the most part, they're exceedingly interested in startups. Like, they genuinely care about startups. They're fascinated by them. They like to hear ideas. And so I really encourage founders to simply participate in the conversation. VC Twitter is very much a real thing. If you go on Twitter and you hashtag venture capital or hashtag VC and just see what people are talking about, contribute to it. Give your 2 cents. Ask questions. We see a lot of communication on LinkedIn. That's where I do most of my communicating. I don't necessarily have a preference for it. It just happens to be where I do that. Instagram, there's communities out there, so you can find VCs and follow them and talk to them. And then Medium, a lot of VCs like to put out their essays on Medium, and you can contribute there and you can communicate. And I will tell you, VCs are pretty quick to reach back out. Especially if you are a founder and especially if you're in this space, sometimes they feel like celebrities. They are much more approachable than celebrities. So after you've been participating in the conversation and you feel like you have something interesting to contribute, or perhaps your product has something interesting to contribute, research an investor and their fund to confirm alignment. I cannot tell you how much, like the most common thing that I get back from investors about a frustration is that founders didn't do their research on them. A lot of times founders hear investor and just assume like carte blanche, they have all this money and it's for whatever they want, and I fit them. And it's just not the case a lot of times. Some of it is a cycle problem. A lot of times funds are raising money themselves. They're talking to those LPs. They're not deploying dollars yet. And founders have not done the research to learn that that's what's happening. And so they're reaching out, and then the investors themselves have to be like, hey, I'm not deploying yet. And it's just a sign that you didn't really do your research. But the other thing is just check size, area of interest. So if you're trying to raise 250,000, you probably don't want to go approach a company or a fund that typically writes $10 million checks. It's just not aligned. If you are a social impact organization, perhaps you don't want to go to a strong high-tech fund where whatever you're after is just misaligned from a thesis perspective. So be cautious with that. I say to just be respectful to investors and their time. Again, you've heard me be a little snarky. I don't always agree with investors, and I think there's a lot of nonsense wrapped up in being an investor. But I do think that one of the things that investors don't have is infinite time. And the reality is, I think a lot of founders just assume that because they have money, they should, talk, and it makes investors' lives very difficult. So the last step there is then once you get all this lined up, you've been a participant in the conversation, you've gotten to maybe know some investors digitally, you've researched and figure out who you want to talk to, slide into their DMs. I would say be clear about why you want to meet with them when you're trying to meet. Are you pitching or something else? I encourage everyone to reach out about something else. There is an old adage in fundraising: if you want money, ask for advice. If you want advice, ask for money. Typically going in with questions about, especially in an area of expertise, how can you help me? How can I help you? What can I do differently? Can I bounce some stuff off of you? Tends to be a more effective way of garnering investor interest, because occasionally you spark their curiosity to learn more, and then they feel like there might be something there. The other thing I would say, and this is just me personally, I have never had an easier time getting investor conversations than during COVID. I think something be said about us all just kind of being in the same situation. Geography matters a lot less. Used to be very common adage, like eventually you got to go to San Francisco. And I think a lot of people still feel that way. It's just not the case. Like I've been able to have so many very strong conversations with investors all over the country simply because we're all just sitting at home and video makes it really easy for us to communicate. And then the last way to communicate or get in touch with an investor is get a warm introduction. And I have a little frowny face next to this because it bums me out personally. But it is by far the single easiest way to get in touch with an investor is to have someone make an intro for you. I want to be fair to investors. I understand why. When you publicly have a bunch of money available, you end up with a tidal wave of cold outreach saying, I have the next idea that's going to change the world. And it's really hard to know what in there is nonsense and what's real. And it's a ton of bandwidth suck. So what ends up happening is a lot of investors then turn to their network and they go, well, I can't deal with these million emails because the last 7 I looked at were terrible and they don't even make sense. So I'm going to turn to my network. But unfortunately, that network tends to usually be pretty homogenous. A lot of older white dudes kind of running the show there. So that's why I don't love warm introductions, but I can tell you it is the single easiest way to get in touch with a VC is to find someone that will make an intro for you. And then it comes time to pitch. So we talk about pitch decks. First thing, keep them short and sweet. Similar, if you guys are familiar with the term MVP for minimum viable product, I feel that same way about pitch decks. Like make it as short as you can to get your point across. Don't make it so short that you cut yourself off, but there is an abundance of over information in pitch decks. Similar with focus on visuals, both of those two things are by far the most common advice I give to founders after I review one of their decks is this is way too long and you have way too many words in here. So focusing on visuals, let them tell the story. Graphs, charts are quickly tell a story. Let images tell the story. And part of that also goes to when you're presenting. Right now, if, for example, I had listed out every word I'm saying to some extent, you would be reading while you were listening to me, which is not what I want as the presenter. And it's not what I want when I'm pitching an investor. I want that investor paying attention to me and letting the pitch deck complement the story that I'm presenting. So then, oh, and here I want to just mention another definition, total addressable market, TAM, T-A-M. Total addressable market is something that absolutely has to be in your pitch deck. It's the overall revenue opportunity available or foreseen for a specific product or service is the definition. Easier way to think about TAM, and there's a few different ways to calculate it. There's a top-down model, a bottom-up model, and there's a more speculative model. You can Google how to calculate TAM. There's infinite articles about it. But the reason that it's so important to include is because it gives the VC a very quick snapshot of how big is this opportunity. Even if they don't understand your idea, they don't understand the tech, they can quickly see if it even makes sense for them to learn those things based on the market opportunity. I can tell you this month alone, I have had 2 different investors who I think are very good investors. I think are very down to earth investors. They are not the kind of investors that I tend to not like. 2 different ones tell me that currently, not a hard line, but are pretty much avoiding products that don't have a $10 billion TAM. Now that is exceedingly high. I don't want to pretend like it's not, but I think it gives an important signal, and it's something that has encouraged me to re-emphasize TAM when I'm talking to founders about how much weight it's carrying, at least with certain investors. I don't know if that's a direct relationship to COVID and just a little more careful, but when I pushed back on with one of the investors, the way he explained it to me was basically he wants room for multiple winners, and he knows that a $10 billion TAM will allow a company he invests into to make enough money for him to make the money back he wants and still not necessarily dominate the space, to allow for other companies to come in and win as well. He doesn't need to pick the only winning horse to still make his returns, which I do think makes financial sense. So keep that in mind as you're building out your pitch deck. What's your goal? Now, almost every founder I ask this question to says, I want to get funded. I want to raise money. I want to find funding. I encourage every founder to remember that at least on your first pitch, your goal should really just be a second meeting. Like, make your goal interest and exciting. Excite that investor, hit the right notes so that they want to keep talking. If you try to sell that investor on writing you a check that moment, I guarantee you're going to have to go too deep. You're probably going to put more info than is necessary in your pitch deck, and you're probably going to get more granular than you really need to for a first conversation. So make your goal a second conversation as opposed to funding. I have this little kind of fairly janky image right down here, but what that represents is I had a very smart mentor basically tell me to think of every investor interaction as a data point. And every single time you interact with an investor, it puts a new data point in the relationship. And sometimes that's a really small data point. You just send an email update and maybe they don't even respond, but you land on their radar. Sometimes it's a really big jump. You ran into them at a pitch event. They got to see you pitch and they really liked where you were at. But eventually all those data points lead toward a trend line. And that trend line eventually leads toward ending the relationship with them because they're just not interested, or keep maintaining the relationship for a future project, or them connecting you with someone else that they think might be a better fit, or ultimately leads them to funding you. So be very, come in with realistic expectations when you're pitching investors, and recognize that you're just trying to get a second meeting and maintain the relationship in a positive way. Again, investors like startups, they like founders, they're interested in this space. They usually want to help. They want to connect you with someone else that can make it work for you. They're very open to that. And then the last thing is, what's your ask? And I want to be clear that these are 2 different things. You should have a goal, but you also should come in with an ask. I think especially first-time founders have a very hard time asking for something specific. And some of that becomes a lack of knowledge, which we're hoping to bridge the gap on here. I can tell you, I still struggle with an ask because for the most part, I'm more interested in the work that I'm doing, and I'm interested in the impact than I am necessarily on making $1 billion, which is not what an investor wants to hear. So I have to be a little more conscious of my own asks. So we're going to walk through what an ask looks like and in the terminology that an investor would maybe want to hear or at least understand. So pitch deck, what's your ask? So here is a clear ask. We're raising $1 million for 18 months of runway at a $5 million valuation. Now, if you are like I was about 5 years ago, I would read this sentence and go, I definitely see words in here that I understand. I have no idea what they all mean together. And so we're going to break this whole sentence down into digestible, understandable parts. So the first part, we're raising $1 million for. This is very clear. I am raising $1 million. I'm trying to get $1 million. Now, how do you get to that number? Well, there's no exact science. But typically, you're based on OpEx, your operating expense. That's based on some growth milestones that you're hoping to achieve. Some of it is based on stage, especially if you're a little bit further along or previous valuations. All of those sort of factor in. But ultimately, what tends to drive that number, the dollars you're asking for, is actually the second part here, the 18 months of runway at. So we're going to talk about some startup terms here. First is the term burn. Burn is a measure of negative cash flow in a given month. So a burn rate of 50K means my bank account balance is down 50K each month. That's what my burn is. Now, runway is a measure of how much longer my business has money to operate. Runway is calculated by taking my bank account balance and divided by burn. So if in that 50K example, if I say my runway is 6 months, that means that I have $300,000 in my bank account because I'm burning $50,000 a month. So when we go to then the ask and I say, knowing that $1 million provides 18 months of runway, I can calculate burn as about 55K. $1 million divided by 18 is about $55,000. So the way I get to this $1 million, at least in this instance, is how long I want to operate. And typically when you're raising money, especially early on, you're looking for somewhere between 1 to 2 years of runway. A big reason for this is that investors need to make sure that you're frankly asking for enough money to be successful. It doesn't do them any good to give you $100,000 if you really need $1 million to get there. And so they want honest answers here, but the math needs to work out to be explained in a way that's logical. At the same time, I wouldn't necessarily be raising $10 million. I would never, when I'm only burning 50K a month and things are going okay. So then our final section here is we're raising $1 million for 18 months of runway at a $5 million valuation. So there are kind of two types of valuations. We have post-money valuations and pre-money valuation. A post-money valuation is the value of a company after an investment. So a $1 million investment at $5 million post-money would create an ownership stake of 20%, 1 million in at 5 million total. Now, a pre-money valuation is the value of a company prior to investment. So $1 million investment at a $5 million pre-money would create an ownership stake of 16.6% because that 1 million would be added on to the 5 million already. So it would be 1 million out of 6 million. And as far as the post-money valuation would be after the $1 million was in. As far as the statement here, we're raising $1 million for 18 months of runway at a $5 million valuation. Now, I did not clarify whether that was a post-money or pre-money. I promise you that will come up from an investor, but typically in that statement, everyone at the table is going to assume that's a post-money valuation. An investor would hear that and assume that they would be getting 20% of the company for that $1 million investment. So I want to talk a little bit about the venture funding ecosystem. Again, I am focused on the United States. My apologies to the people that I know stayed up late to watch this. Most of it is still relevant to you, but the stats are going to be a little bit different. So the first question is, who are venture capitalists? Well, venture capitalists, at least who self-identify as venture capitalists, are overwhelmingly white male. This stat here kind of blows my mind. 40% of people who identify as venture capitalists went to either Stanford or Harvard. That's why when I was going through my bio, I'm very quick to mention that A, I did not go to an Ivy League school, and B, I don't have an MBA or a JD. I am definitely an outsider, and at least as far as the conversations are concerned. Where does venture funding happen? Well, 70% of venture funding takes place in 4 cities right now. Silicon Valley, New York, Boston, and LA. Majority of that is dominated by Silicon Valley. This is something that I am already seeing a shift in because of COVID. People are a lot more comfortable. I was actually talking to an investor today that is raising a very cool underrepresented founder fund, and majority of his money is coming from the Midwest so far, even though he himself is located in California. So I'm really encouraged by that. I hope we can change this number. If anyone on this call is into ecosystem building, one thing I would say is don't try to be the Valley. I think that's a big problem that a lot of different ecosystems have, is they want to be Silicon Valley, and I just don't think anybody can. I think that is a unique situation that is not going to be replicated in the same way. Instead, look at what's unique about your community and try to build something else that fits that authentically. That would be my advice there as far as ecosystem building is concerned. Who receives venture funding? Well, less than 3% goes to Black, Indigenous, people of color. Less than 4% goes to female founders, although they typically do return better. 0.0006% of funding goes to Black females, which leaves 90% for white, male, straight, cisgendered. This is a pretty homogenous group who's involved in venture capital. I often tongue-in-cheek, but I like to say it's mostly white dudes on the coast giving money to other white dudes on the coast. So this is something that I'm passionate about changing. One other stat that I want to throw in here, because it's mind-boggling, and not just mind-boggling from a social impact perspective, but strictly from like an investor ROI perspective, there are only 35 Black women who have ever raised $1 million. The median venture fund size is $75 million. So the fact that only 35 Black women ever have raised that money is a huge inefficiency. If you're an investor and you got some dollars, look at your female founders of color, because there is tons of opportunity there. So when I first started learning about all of this discrepancy, I started talking to investors and I said, why is this? And the thing I heard over and over again was the pipeline problem. And the pipeline problem essentially breaks down to investors telling me, hey, Forrest, I'm founder agnostic. I don't really care. Background, gender, identity, none of it matters to me. All I care about is making money. I just don't see enough of diversity in the founders. I just happen to only have a portfolio that's all white dudes because that's who's come to meet me. Okay, I don't buy it, but I will tolerate it. So that's really what led us to create Uncrowd.io. We built Uncrowd to be a pipeline problem killer. And if you're unfamiliar with Uncrowd, I know we have a lot of people who are on the platform already on the call today, but if you're unfamiliar, basically what we do is we bring underrepresented founders on one side of the platform. We add investors on the other side of the platform and make it really easy for investors to add to their top of funnel deal flow. So essentially killing the pipeline problem. Investors can come in here and they can filter by whatever they want. If they like to invest in B2B SaaS companies with 100K rev, they can do those things really quickly. And that's really what we're doing here. Okay. Oh yeah, good. So as far as resources, following up on Intro to VC, if this is interesting to you and you want to learn more, you should read these books, starting with Venture Deals. Start with Venture Deals before you do anything else. If you are having venture capital conversations with somebody, assume they have read Venture Deals. Assume it sat on their nightstand for some time. It is basically the VC Bible, and you will be behind the 8 ball if you haven't read this book. The second one then is Mastering the VC Game. It's another one that starts to make things make a little more sense and start to round out the ecosystem. But I can tell you, I almost everything. I mean, I certainly learn a lot from conversations, but most of what I know from like a pragmatic or practical sense is from venture deals. With Uncrowd, we are also building out a content hub, which we're excited about. So we're trying to build out a place where more founders can connect, where we can tell more founder stories. This is another place where we hope to be a resource for venture capital. You can check it out now. It is live, uncrowd.webflow.io. We built it on Webflow so we can get it up quick. Oops. And if you want to contribute, we have some pretty amazing founder stories right now. This one that I highlighted here, The Black Formula, The Journey of a Black Founder. It's a long read. It is such a good read, though. It really tells the story of what it's like to be a Black founder trying to raise venture capital. If you want to contribute, we really want founder stories. We want investor stories. We want to highlight other perspectives. Shoot Adam an email, adam@uncrowd.io, and just tell him like, hey, I want to write something up, and we will gladly put it on there. Also, I would say tips, like if you just see an awesome article and you're like, this would be great for Uncrowd, please send it to Adam. We would love to, we really want to create this awesome content hub for everybody. That is really the end of what I wanted to cover today, but I want to make sure there's time for questions. And I do see some stuff in the chat. So I would say, first off, feel free to email me. I am incredibly accessible, intentionally so. This is my real email address. Like, you can hit me up if you want to have questions about VC. I will give you my best advice. I am going to quickly look at the chat and just see if I've got anything here.
Hey, Forrest, I have a question for you.
Yeah, hit me with it.
This one question came up. It says, if you wanted to invest in a VC fund, what is the minimum amount that one can invest, and how does one find the appropriate VC fund?
Oh, good question. So we start to get into kind of LP territory there of like who is an LP. There are going to be requirements. I'm pretty sure that you have to be an accredited investor, I think, still to be an LP, although maybe I see a couple people on here that have raised funds. So if anyone wants to chime in and tell me if there's things beyond just accredited investor, that would be awesome. But aside from like finding a fund that you want to invest in, it's a really good question. Truthfully, there's a product, and I'm not just saying this because I know he's on this call, but Grady Buchanan has a product called OmniValley that is basically what we do for Uncrowd, he does for investors, and he connects investors. And so if you're curious about figuring out a fund that you want to be a part of, OmniValley is a really good resource for that.
All right, Forrest, I got another question for you.
Okay.
Is a good VC someone who has been a founder? How does one really hone their VC instincts in assessing talent?
It's a really good question. I will give you a diplomatic answer, and then I'll give you how I personally feel. I think the diplomatic answer is that venture capital is inherently risky, but VCs are not. I think good VCs are very quantitative. They think about returns. They about the numbers and make sure the numbers make sense. And all of that is true, regardless of whether they were a founder or not. Venture capitalists or investors, they have a literal fiduciary responsibility to their LPs, their limited partners, to make sure that there's returns and that they're doing things effectively. And so anyone can be a good VC, I guess is my point. Now, with that said, I think previous founders are a lot more empathetic. I think previous founders understand the journey of raising capital in a way that a lot of VCs don't. I also think founders happen to be a little less risk averse. I think they understand, they have a little more vision for what could happen, or a little more comfortable investing at a stage that is earlier, where there's less traction. So I like founder VCs because I feel like I can talk to them a little more openly and a little more honestly.
All right. Now we have somebody who just started a business and they're trying to figure out who they would work with to figure out what they need to work on before going to an investor.
Oh, okay. Well, I would say look for free resources in your community if it's available. There's also stuff online, but I can tell you, like, encouraging startups is like a popular thing in every ecosystem right now. Every major city wants a better startup ecosystem than they have. And so there are all kinds of free programs and free opportunities to get involved and connect. And frankly, meeting with other founders is really, really helpful when you're early on. I have more founders than probably is fair that are one email or Slack away when I just need to bounce a question off somebody and be like, hey, does this make sense? Or can I bounce this off of you? Because getting to a place where you can reach out to investors it's important. Now, with that said, again, a lot of investors are totally cool to have those conversations too. Like that specific question, like that's a really good question to ask an investor to open the door. So when I talked before about asking for advice and not money, that's a really good one to ask for advice. Like, hey, I'm a founder and I'm trying to figure out when I'm ready to raise capital, what I'm missing. Could you give me some advice about what would make sense for someone, if someone was approaching your fund? That's a really easy way in the door. So that there's opportunities there. In general, and then more specifically, just transparently, like you can just email me. Like I almost every week I tell somebody to send me their pitch deck and I give them some comments. I cross stuff out and add other stuff, and I just am happy to do it.
All right, thanks, Forrest. Got another question back to TAM. Are there any respected data sources to use when developing TAM, or any sources that investors typically rely on to get their data inputs?
Yeah, so TAM is a little bit of magic math. So on one hand, I said, they care about a large enough TAM and some care about a $10 billion TAM, but also like you're doing some pretty speculative math a lot of the time. And so the way that I describe kind of the data sources, well, don't be lazy, but I also don't think you don't need to necessarily pay for market research, which is services that are offered. I would say do the most free market research you can. So look into, and a lot of that's just Googling, figuring out the right thing to Google, reading reports. Industry reports are super helpful for figuring out TAM. But as long as you can quickly rationalize the math, and a lot of times that means walking a VC through the math in a very quick way, like here's how I calculated my TAM, because they might have opinions on it, but as long as you can articulate that what the way you did it made sense, that's oftentimes good enough for that first conversation. Now, if they think you're way off the mark, they might go and do some research on their own, or they might ask for more specificity, like, hey, can you go through that with me or send me over your data if they're finding something different. But I definitely I don't think it's worth paying for market research in TAM, if that's helpful.
All right. And then are there any good places or resources for what good metrics are for VCs or what they're looking for?
Yeah, that's a great question. Like I know some numbers off the top of my head, but I don't know where I got those numbers. So I can tell you, like, from spending some time in consumer packaged goods, CPG, which was a subscription business, we were always, the data we really cared about was CAC, customer acquisition cost, to lifetime value, LTV. And I just know offhand that a 3-to-1 CAC to LTV ratio is okay, or LTV to CAC ratio. 4-to-1, it starts opening the door to investors. 5-to-1 plus, and investors will probably be reaching out to you. But I'm not sure where I got that information. And I think it just came from investor conversations. So that's where, and I guess an important part of this is a lot of investors have what's called, proprietary deal flow, but going into that is proprietary data. The VCs themselves raising funds is them basically competing against each other for the limited partners' money. And so they have to have some secret sauce that indicates like, hey, I do this better. I can find better companies. I can do better diligence. I can make smarter investment decisions. And so sharing data is not always super available, but at the same time, like I really think Twitter is probably your best answer. Like find some investors that are in your industry on Twitter and notice what they're talking about, notice what they're directing, and see what you can find there. That would be my advice.
All right.
Oh, Adam, can I go back to that? Because I want to pause for a second, because I think that was a little too vague. Sure. I will say, like, at a broader level, like, traction is really what gets investors excited. Especially in the Midwest, there just is not a lot of money, if any, for R&D. So finding traction, and usually that means revenue, and a lot of times that means pretty substantial revenue, is what's going to get investors excited. Now, you can rationalize some other traction, especially depending on what your thing is. You might say users, if you've got magnitudes of users that you feel confident and you can rationalize like converting into revenue at some point. But at the end of the day, money talks. And if you have high revenue, if you are growing substantially, like growth and revenue are really like the things that are going to matter at the end of the day.
All right, thank you. Now, can you speak a little bit more about how one would enter into the venture capital ecosystem from a non-traditional background, say engineering? What transferable skills are most important, and what types of roles should they seek out?
Okay, yeah. So someone who wants to be an investor, good question. So the real snarky answer is go get an MBA at an Ivy League school, and you'll be right on the path. But the general answer is a lot of investors are frankly more open to help than seems to be the case. Now, I mentioned, accessibility. Investors often present themselves as less accessible than they are simply because they just don't want to get pitched everywhere. They don't want every person that knows that they have money to be sending them ideas and soliciting them for money. But if you are willing to kind of explore opportunities, like reach out to investors and let them know what you're good at and what you're interested in. And the investor communities themselves are pretty tight, so they might know other people. I recently heard of a product, and I'm spacing on the name of it, but I thought it was really cool. It was specifically to help democratize who can become a VC, because it does tend to be also a pipeline. And what they were going to be doing is essentially gamifying venture funding and deal flow, where they were going to be letting people actually run their own deal flow and then seeing what the results turned out of based on those companies, and then letting that kind of build a portfolio, almost like a virtual portfolio, to show that they have skills, like that they actually knew what they were doing, they did their research, and they could demonstrate it. So with non-traditional background, like engineering specifically, like if you can do quantitative analysis, so if you are getting into the place where you're doing, data analytics, like there's always room for that at a VC firm. But then the other thing, and this is kind of the dirty little secret of venture funding, is that until you get to a substantial size of a fund, like it is not super lucrative. Like it is not a thing where like it feels like they have lots of money. But when you go back to just that, 10 or that 2 and 20 model, well, if we have a $10 million fund, and I'm going to do some math really quick to make sure I'm not wrong about this, 10.2. So you really get, that would be, do I have too many zeros? No. So it's $200,000 a year to run a $10 million fund. And so that if you go like, okay, well, I'm going to take a salary because I need to live and I need to pay rent. Well, that eats into that. And then you go like, okay, well, I want to hire a person, maybe one other person. Like, okay, I maybe can hire one other person, but then I still need to make sure I'm doing the job, which means a lot of times, or previously meant, traveling around and going to meet with founders and things. So it is that those operational costs burn up pretty quick when you are not a mega fund. So just something to keep in mind, that there just might be less room at a fund than you think.
All right, that wraps up all the questions that came in through the chat. Does anybody else have anything else they'd like to ask first?
Yeah, if anyone has any questions, you can either unmute yourself, you can put something in the chat, or you can pop your video on, whatever, or just let me know. Okay, I going once, going twice, sold. All right, so anyone, please feel free to shoot me an email. I'm happy to answer them. I'm happy to, I love giving this information away. We really are hoping to do more stuff like this. So again, anybody on this call that's a founder or an investor and feels like they have something great to contribute to the community, we would love to we're really working to support underrepresented founders in a new way. And we think being a little more direct with that instead of just supplying investor connection is a way to do so. And we're hoping that we can start generating more entrepreneurs. That's really our goal.
All right. Thanks, Forrest.
Thanks, everybody. Have a great night.